Hello, I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and welcome to the final presentation of our summer series of webinars. Presenting today is Gabriel Sachs, manager of the Aberdeen Asia Focus Trust, which owns a portfolio of some of Asia's most exciting smaller companies. For those that are new to these presentations, the format will involve around about 30 minutes of presentation on the trust and the asset class before handing back for 15 minutes of Q&A. Listeners can submit questions through the Q&A function in WebEx, and we will monitor these as we go along and put them to the manager at the end. We'd recommend that for the best experience with these presentations to download the WebEx app, which will probably allow you to watch use the slides and do the Q&A function as well. So that's plenty enough from me. Gabriel, please take it away.
Thanks very much, Ryan. Thanks everyone for joining today. It's a beautiful sunny day in London, Wimbledon, day 3. So I'm sure there's lots of other things you could be doing at the moment. So thank you for listening to me present. As Ryan says, I'm the lead manager of Aberdeen Asia Focus. I've been with Aberdeen for 17 years this year and involved with the trust for the last 7-8 years. As Ryan mentioned, we are looking to invest in the highest quality businesses we can find within the Asian small cap universe. We think that we're in a very fortunate position because these are under-researched markets in the small cap end and large and fast-growing economies. So we really think that there are, hundreds of exciting businesses that we can invest in. And when you look at, this is not a purely promotional slide, although it is a little bit as well. I think when you look at the history of the trust, we are celebrating 30 years this year. You can see that actually we have been able to deliver pretty good net asset value returns annually of about 12 to 13% over the life of the trust. It's always been managed by Aberdeen. And I think that's really, again, a reflection of the fact that this is a very attractive part of the market to be investing in with lots of growth. We think that 12 to 13% net asset value return per annum is sustainable. And I say that because when we talk to our companies, invest in our companies, we do think that 10 to 15% earnings growth is something that is very achievable for our companies. And if you believe that share prices will follow that, you should be able to take advantage of that net asset value return over the long term. Obviously, you need to make sure that at the time of purchase, you're not buying these things at ridiculous multiples. But provided that's the case, then you can just enjoy the growth that these companies offer. Just in terms of reference to the benchmark here, our closest benchmark is the MSCI Asia ex-Japan Small Cap Index. So the universe that we're looking at is all of Asia, excluding Japan, and also excluding Australasia, which through the history of the trust, we have actually invested in Australia, but back in 2021, we removed that from our index. A quick kind of recap on why Asian smaller companies. When I speak to a lot of investors in the UK, I do feel that the asset class is not a priority for many people, and a lot of people don't allocate at all to Asian small caps and will allocate to potentially 1 or 2 large cap mutual funds or ETFs. But we do think that there is merit in investing in smaller companies in Asia. One of the reasons is, it is truly differentiated. It does offer you access to different themes and to different countries. When you look, we have a slide later on showing this in more detail. But China, for example, is only 15% of the small cap index, but more like 36% of the large cap index. And these are businesses that tend to be less correlated to each other, lower foreign ownership, which also means that when there is correlation sort of move towards one, and you see sell-offs in markets, Asian smaller companies actually can reduce risk and provide good diversification. The other reason is obviously the outperformance potential. If you look at every year, in the last sort of 15 years, the range of returns that you can get from small caps is higher than large caps, provided you pick the right ones. Every year you see stronger performance from small cap parts of the small cap market. And actually, if you look at the last 5 years or so, the differential in Asian small caps versus large cap has been over 40% cumulatively, or about 6% per annum. So this perception that Asian small caps haven't performed well, they're higher risk, has not actually been true when you look at the last 5 to 10 years. It's actually been an asset class that has delivered lower risk than small caps in developed markets and much better returns than large cap as well, which again is a different perspective when you look at, for example, small caps in the UK or small caps in the US, where they've significantly underperformed the large cap part of the market. Just to reiterate that point in terms of differentiation, we do think that the key attraction of Asia Focus is that it's giving you access to companies that are very difficult or probably inaccessible to UK investors via mutual funds or individually. You can't really just log into Hargreaves Lansdown or AJ Bell and buy an Indian small cap or an Indonesian small cap. And these businesses are fantastic businesses to own. And, they're not present in most mainstream portfolios or ETFs. So, people will allocate to a large cap Asia mandate, where 20% of that portfolio will be invested in TSMC, Samsung, Tencent, Alibaba, which are great companies, but you end up with replicating your exposure that you have in other portfolios, be it global portfolios, be it tech portfolios. So we really feel that Asia Focus is giving you great access to something different. And you can see here just a few characteristics. The portfolio has about 50 to 60 stocks. That compares to over 1,600 for the small cap index. In fact, if you look at the local indices in many of these markets, there are many other companies that are not even in the MSCI benchmark. And so the active share of our portfolio is 96%. So it's totally different even to the small cap benchmark. The other characteristics is, small cap versus large cap, as I mentioned, has a much lower allocation to China and gives you more exposure to markets like India, Taiwan, and Southeast Asia. And you see that borne out also in our portfolio, where India is about a quarter of the portfolio. Southeast Asia is another 20% or so. China, including Hong Kong, was about 15, also inching up towards 20, and then Korea and Taiwan is another 20%. We'll see that in the positioning later. But basically, quite differentiated exposure by country, by sector, and individual stocks as well. I guess just probably should have started with this, but in terms of our investment process, it's not rocket science. We're really trying to find companies that we think are the best businesses out there. When we talk about quality, what we mean, first of all, is companies with good management teams and good governance framework. I think when abrdn started investing in Asia back in the 80s, backing the right people and trusting the promoters and the families and the management teams of these businesses was critically important, and is one of the reasons that I think over the many years we've been able to avoid some big blowups in Asia, and that remains true to this day. I think governance has evolved towards ESG as well, so that's something that we take very seriously and engage with our companies on. It's a critical part of what we do in terms of analyzing companies and rating them on quality. Every analyst on the team will incorporate ESG in their assessment of companies' quality. And then I think the second thing, which is probably the most important, is how differentiated that business is, what makes it, what's its secret sauce. That means that it can sustain pricing power, competitive advantages, be that in terms of cost, in terms of brand, in terms of distribution network. So we spend a lot of time with the management teams trying to understand their industry position and why they're a leader in their market, or why they can be a leader in their market. And pretty much all the companies in the portfolio are market leaders, either within their respective industries or countries, or in the case of Taiwanese IT companies, they're probably the best at what they do globally. So they're global leaders, even though we classify them as small cap. The third thing I would say is around financial strength. We don't like companies that take on too much leverage. So you can see here on the middle chart, that our portfolio is sitting on net cash. That compares to about 15-20% net debt to equity for the index. So our companies are quite conservative or have very healthy balance sheets, which we think position them really well to continue investing and to sustain and survive in tough times, and actually do better in tough times because they can acquire or continue investing. And in terms of quality, in terms of quantitative measures, apart from the balance sheet, higher profitability is also something that shines through in terms of the ROE there that you can see on the far right, with our companies having an ROE of about 18% compared to closer to 10% for the index. So those are really the key attributes of quality that we look for. We try not to get too bogged down on the value versus growth debate. I think we really want to buy growth at the cheapest possible price, but you do often have to pay a bit more for quality. So I would say that when you look at us relative to the index, we will be a little bit more quality growth oriented, but the idea is really to try and be disciplined on valuations. And the nice thing about operating in a large region like Asia is that you can have parts of the portfolio that are very cheap and that offering dividend yields almost double digits. In some cases, they are offering double-digit yields. And in other parts of the market, let's say like India and Taiwan, you get growth rates of 30-40% per year in terms of earnings. You don't get high dividends, but you do benefit from that growth as well. And despite that being a growth stock, they are businesses that you can justify in terms of valuation as well, based on the growth that's coming through. So that's the key for us. I think in terms of positioning of the portfolio, you can see that I think the key objective here is to be diversified, both by country and sector. We want to be able to give our investors access to lots of different themes in the region. Asia is very diverse. There's a lot of exciting themes. First and foremost, the domestic growth story in Asia, which remains very exciting. So we do have exposure to consumer staples, consumer discretionary stocks. You can see that on the right-hand side is about 20% of the portfolio. But we also really like the IT space. As I mentioned, we do think the Taiwanese supply chain has global leaders at what they do, companies that are impossible to replicate, despite all the noise about global trade and conflict. These businesses will remain embedded in technology supply chains, whether they have to relocate part of their supply chains or incremental capex might go outside of Taiwan, in which case, in many cases, it already is outside Taiwan. These businesses have very strong IP and sell into the US hyperscalers as well. So that's a key part of the portfolio, although within tech, we do have quite diversified exposure as well to IT services and software companies, which are more, which have very different drivers to the semiconductor space. Outside of that theme, we've got green energy theme emerging. I think if you look at the renewable supply chain, a lot of that is coming through in Asia. Asia does dominate in wind, solar, electric vehicle batteries. The auto industry, in terms of how the Chinese are dominating that now. They're the largest exporter of cars globally these days, and by far the highest penetration of electric vehicles anywhere in the world at over 30%. The incremental sales now are more in EVs than they are in internal combustion engines. And so there's a lot of new technology and advancements around that space, which are quite exciting as well, that we tap into. Within China, there's also things like AI, which has been more in focus after the launch of DeepSeek, which we can talk about in the Q&A section as well. But broadly speaking, we capture a lot of themes from a sector point of view. Healthcare, financials, industrials, given the strength of the manufacturing and industrial base in Asia. You find niche companies that are the best at what they do in several different industries as well. We're a little bit light are things like materials, as you can see on the right-hand side. We have one stock in that space. We have relatively little in real estate and energy as well. materials are not necessarily your typical commodity mining businesses, but primarily chemicals companies in places like India and Korea. But we don't have a lot of exposure there, as I mentioned. I'm laboring a little bit too much on this slide, but I think it's important. I think on the country point of view, you know, India is a market that we've always really liked. It's extremely rich in small and mid caps, very entrepreneurial, private sector driven corporate sector. A lot of activity. You know, if you look at the IPO market globally in the last few years, most of the IPOs globally have come from India. There's a huge amount of excitement from domestic investors who have been allocating more to mutual funds and the equity market. So you're seeing domestic investors support the equity market, particularly in the small and mid-cap space. We are underweight India, given it's a large part of the index, and valuations are a little bit high. So we're leaving some room there to add opportunistically as we see opportunities come through, but it's still a key part of our portfolio. You might want to include Sri Lanka within that Indian subcontinent space, which is a conglomerate in Sri Lanka that's also a play on India tourism, because they have hotels, they have logistics operations as well with an Indian partner, with one of their largest transshipment ports in Asia, and several other businesses there. But it's our single holding in Sri Lanka. Then, as I mentioned, we've got about 20% in Korea and Taiwan, which were both underweight those markets relative to the index because they are more tech heavy, more export oriented, and more mature. So we really like selectively buying into global leaders in that space, but we don't necessarily want to buy local banks, you know, supermarket chains where there's limited room for growth. So our Korea and Taiwan exposure is a little bit more export oriented. And then we have a good chunk in Southeast Asia and China and Hong Kong as well. What I would say is, I think, as I mentioned, you know, there is a big valuation differential between markets, growth differential between markets, but, you know, we like to have quite a diversified portfolio, and a lot of these stocks are very different, as you'll see when we talk about our top 10 holdings. The other point I'd like to mention is that, you know, whilst we do have exposure to export markets, 80% of the revenues from the companies in our portfolio are to Asian clients. So the real vast majority of the revenues and earnings of our companies is driven by domestic growth and intra-Asia trade, which is quite important these days given concerns about trade barriers and whatnot. So we can talk about that a bit more detail later as well. Here's our top 10 holdings. This is actually to the end of March. It's a little bit out of date, but just to give you a flavor, you know, you can see that our top 10 is about 30% of the fund, and that's less than 1% of the index. And a lot of our names there are not even in the MSCI index. So very differentiated. We try and be long-term shareholders in companies. So you'll see that most of them we've held for 5 years or more, but occasionally, you know, we have businesses that have done very well in shorter time frames, and that we've ramped up our exposure there. You can see that, you know, within our top 3, let's say, you know, Aegis Logistics is an LPG distributor in India. So it's really playing into alternative fuels, you know, as India has a lot of demand for energy and the government is keen to move away from coal. LPG is a pretty good alternative, and Aegis Logistics has been investing in a network of ports and port terminals and storage facilities for many years, sunk a lot of capex there, and now their barriers to entry are incredibly high. They also have pretty much fixed margins, which de-risks the business, and it's virtually all a volume game, and they've been growing volumes 20% plus per annum. They've partnered with a Dutch company, which is the best at what they do globally as well, and they use Aegis as their India play. So this is a nice kind of energy demand infrastructure story in India. And that's very different to what we have here, number 3, for example, which is a auto components business. They have over 50% market share in manufacturing electric vehicle gears for guys like Tesla in China, BYD, Li Auto, all the OEMs. So you're playing into the EV story in China, which has been growing very fast without taking on any OEM risk or brand risk. And that business has been also growing at 20% plus growth rates year over year. It's done quite well for us. They're very disciplined and in what they do. They have other businesses within the industrial automation space, which kind of leverage on the same type of technology. And they're also moving into robotics, which is partly the reason the stock has done well as well. People are quite excited about that division. Humanoid robotics is a big theme in China, and they're likely to list their subsidiary this year in that space. So those are just two examples. I have actually a few more examples in the next few slides to give you a flavor of what we own. KFintech has been one of my favorite companies in the portfolio for the last year or two. It has done very well, but essentially this is a business that provides registrar and transfer agency services, or easier explained as back office services for asset managers in India. And the nice thing about this business is that it's a duopoly. There are only two players that do this in India, and there's been consolidation, so they control the market. They've got very, very sticky customers because asset managers don't want to change their back office frequently, and there's only really two players that can do it. And we feel this is by far the best player, even though they're the number two player. And it just offers you recurring income stream as AUM grows in India. And assets under management in India have been growing at a very fast pace, given that equity culture that's been developing locally. It's, I have no doubt, the fastest growing asset management industry globally, at least one in scale. And you're seeing retail investors, allocate small amounts on a monthly basis to the equity market. And you see this here on the top right, which are the systematic investment plans, these SIP flows growing consistently year over year, which also provides a nice backdrop for KFin, who make only a 4 to 5 basis points fee on their services, but they operate at very high return on equity, a 40% plus EBITDA margin. And again, it's a nice recurring story on the growth in the domestic asset management industry in India. On top of that, they've been diversifying into other areas of the capital market space in India, which are growing very fast, faster than this business, and also internationally. So they've been signed up as a partner with BlackRock to provide support services for asset managers globally. They're probably the one that is going to offer that at the cheapest possible cost, given international players charge 3 or 4 times what they charge and manage a lower number of transactions. So we think that the international opportunity for someone like KFin is very exciting as well. And they've just made an acquisition in Singapore, which gives them access to about 17 different countries and licenses there in terms of, Southeast Asia, Luxembourg, Dubai, US, and Europe. So this is quite an exciting holding, not cheap, I would say. So we have taken some money off this week from this stock, but we think the medium to long-term outlook is still very exciting for KFin. This year we have been a bit more active in adding to China. Last year we added quite a lot in India. This year we have changed the mix of holdings in China and actually added to China. Our exposure, I would say, is split largely in 2 big buckets. One is industrial automation. I talked about that company that does the EV gears, but we also have another equipment manufacturer that kind of plays into the automation story in China, given demographics, given the strong manufacturing export market. Automation is a big theme, and we see a lot of strength and growth in that space. So we have that exposure. The other area is consumption, and particularly new consumption trends, because traditional areas of consumption have been under pressure. So I was in China in May, and I visited, some traditional businesses, like, in property, in beer, in Baiju, which is the local liquor. Those industries are under a lot of pressure, but there are areas of the market that are seeing very strong growth, particularly with the younger generation. And that's what we're trying to tap into as well. So you might have heard of PopMart, which is a stock that's done very well. We don't own that, but that kind of thing has been quite strong. And here there are two companies that we introduced to the portfolio this year. One is a pet foods company called Yantai, China Pet Foods. They have been manufacturing pet foods for multinationals globally for many years, which provides a cash cow for them to develop the local brand in China. And pet ownership in China has been growing incredibly fast, partly, for reasons that, people are not really having families, but they still want company. And so you're actually seeing pet ownership grow, and people also look to local brands rather than foreign brands, which are cheaper, also give them national pride and have been offering good quality as well. So Yantai plays into that consolidation and growth of local brands in the pet foods industry. And the NetEase Cloud Music is basically a local Spotify. There are two big Spotify or music subscription businesses. One is owned by Tencent and the other one by NetEase. And the story here is all about monetizing their user base. It's already quite well penetrated in China. So it's just about them slowly inching up take rates and offering more paid services, which has been driving their profitability and margins up. So these are both stocks that we feel are completely divorced from the macro environment, from the trade noise. It's all about execution of their strategy in their individual industries. I'm probably taking more time than intended, but I think just quickly in terms of portfolio characteristics, historically quite a defensive strategy. If you look at the bottom left, capture ratios, upside and downside, this just shows how much you participate in the upside or downside. Historically, we've been very defensive. So in market downturns, we've protected a lot and not participated in all of the downside. The nice thing to see over the 3-year numbers there is actually upside capture ratios are quite high. So we're capturing all the upside when markets are up, but we're also being quite defensive over the last 3 years, only capturing about 80% of the downside. And that's down to our quality characteristics of the companies, the lower beta here as well that you see about 0.8, and the lower volatility of the portfolio. A few things I'd like to highlight, we do offer a dividend yield. It's about 2.6% at the moment. We're not necessarily targeting a particular yield, but the board has committed to a progressive dividend on the ordinary dividend. So, you can take the current ordinary dividend as sustainable. And, we look at things from a total return point of view. So definitely dividends is something that we like to see where it makes sense for that company to be paying out the dividend. We are 10% geared. We did in May see a conversion of some convertible debt that we had as part of our capital structure. So that part of that converted to equity, and part of that we rolled into a floating debt instrument. So we've got about half of our debt in a fixed bond or fixed rate instrument, which carries a borrowing rate of about 3%, and another 50% in a floating rate debt, which basically gives us quite nice flexibility if we want to, gear up or gear down from here. Although I think we're quite comfortable with a 10% gearing, and then a discount at 12%. At the moment, this is to the end of March, but it is about 12% today. And the board have been stepping up buybacks quite a lot this year as well, which has actually seen over a longer period of time that discount narrow a little bit. But we still think that still offers very good value for investors. And I guess in terms of valuations for the portfolio itself or the asset class, for the portfolio itself, you can see here on the previous slide, 17, 18 times forward earnings. It is a little bit more expensive than the benchmark, but we feel that is compensated by very strong growth in EPS and high returns as well. And for the asset class in general, Asian small caps are in line with sort of 10-year averages, both in absolute terms and relative to the MSCI World. We think that there's better earnings coming through from Asian corporates. We think the outlook is very strong. Inflation is not a problem. There are risks, of course, as with any equity market, but we feel very optimistic about the long-term outlook. And on the right hand side, you see that actually fund allocations to Asia are at decade lows, and this doesn't even talk about small caps in Asia, which there's very little allocation. When we look at the Aberdeen group as a whole in terms of AUM, we probably manage 10 times more money in small caps in Asia and EM 10 years ago. So that could change. We think that we can't time that very well. We always talk about the attractive valuation of EM and Asia versus developed markets. So this is not something that we have a crystal ball on, but given perhaps some fading US exceptionalism and still strong growth and a robust macro environment in Asia, you could see that turn, and people look to diversify from what are very concentrated equity markets these days, where the US is 70% or so of global market cap, where it represents a much smaller percentage of global GDP and of GDP growth. So Asia represents over 50% of global GDP growth these days. Performance, I'll just finish on this slide. I think despite all the noise and challenges that we've seen in global markets, Asia small caps have delivered respectable returns, and the portfolio over 5 years has returned a similar level to that 30-year return of about 12.7% NAV. The last 1 year has been pretty decent on a relative perspective versus our closest benchmark. That's been primarily driven by positive stock selection in India and South Korea, which I can definitely touch on in more detail should you want to hear more about that. But I'll stop there. Hopefully I didn't talk too fast, and I'd love to have some questions.
Thank you very much, Gabriel. As expected, we have had lots of questions coming in, although feel free to keep asking them with the Q&A box in the corner. We'll start off with just a couple of ones that touch on that previous slide about being underowned and undervalued as the asset class. While it is underowned, could you talk through the domestic flows in the region and how this differentiates itself across all the different countries?
Yeah, so the big one to talk about is India, where India is if you look at performance, India has, I don't know exactly to date, but I think it's been stronger than the US markets, certainly in the small and mid-cap space. It's been a lot stronger. And that's been entirely driven by domestic flows. If you look at global funds, emerging market funds, on average, they're underweight India. And, that's been driven by, I think, optimism around the politics in India. So the domestic investor has been given political stability. He's seeing strong growth in the corporate sector, and he's trying to diversify away from things like property and gold. And there's been also support from the regulator as well in driving this equity market culture. So that's certainly something that I think the domestic investors in India have remained very, very sanguine despite the volatility in global markets. You did see a correction towards the end of last year, early part of this year, which was driven by some disappointment in earnings and high valuations. So I think they're starting to get a bit more discerning as well in what they buy, but certainly the flows remain pretty strong. And we see that when we talk to KFintech, which is a holding in the portfolio, and 361, which is a wealth manager that we invest in as well. Outside of India, Southeast Asia, domestic flows have been very weak. It's not really a story there. So those markets still rely on foreign investment, which has brought a lot of volatility. And one of the reasons why the markets remain very cheap. Indonesia is a case in point where, the market's very driven by bond investors because they're attracted by the high yields. And whenever you see those bond investors get a little bit nervous, which you did see this year, you see capital outflows, currency weakness, and equities also suffer. So that's a little bit of an annoyance in some ways because the market's very cheap and the economy is doing okay. The politics is a bit messy, but Southeast Asia, that is a struggle. Domestic flows in Southeast Asia is a struggle. And Philippines, which used to be a market darling, liquidity is dried up, and it's hard to. I don't think anyone really looks at the Philippines and EM these days. So we do have an overweight there, but it only only 3 holdings. China is the other big one where you need to see some more optimism from households on the outlook. People are still a little bit concerned about most of their wealth being trapped in property and what that's worth. So animal spirits haven't come back in a big way in China, but when they do, the market runs very, very quickly because it's a momentum-driven market, particularly the A shares. So that could really drive the market. And just finally, I think Taiwan and Korea, there are some strong retail activity there, but it can be a little bit more cyclical depending on global market environment.
Interesting, thank you. You touched on lots of the countries that we've had questions in there, so I'm just going to go back to some of them. China actually is probably the most relevant one. You mentioned you've been adding a lot to your holdings in China. Has that been a result of sort of individual stocks coming up as a good value, or is it because of these changing macro conditions that you are sort of adding to the investment case for them?
Yeah, look, I think we've done a lot of research in Chinese small caps over the last 5-6 years. So we do run a China small cap strategy. We have 10 people out in Shanghai and Hong Kong. So actually our pipeline of ideas is really long in China. If you took us back 5-10 years, we hardly had anything in China directly, partly because also our market cap limit was more restrictive at 1.5 billion. We removed the limit. But there's a combination of, we've done a lot of research. There's really good ideas coming through, but also the fact that the market had become very cheap, and we do expect policymakers to incrementally continue to support the economy. So that combination of factors has made us inch up very gradually, actually, our Chinese weight. And some of that weight has increased also partly because some of our stocks have done well. We haven't got it all right. So there's some consumer stocks that we got in too early. So I can think of Hang Lung Properties, which is a mall operator, but it trades on 0.2 times book. Has, when we bought it, close to a 10% dividend yield. But that's been slow to come through. We think they're possibly coming to a bottoming now in the mall, mall sales actually picking up, and excitement around consumption also improving. But it's quite mixed still. So consumption in China is definitely not a clear kind of improving trajectory. It really depends on the segments and the sector, and it's been a little bit slow going. But we think there's some fantastic businesses still in China. It's the second largest economy in the world, one of the largest equity markets in the world. Lots of under-researched companies, particularly in the Asia market. So we continue to find ideas. So yeah, it's mostly bottom up, but there is an element of top down as well.
Okay, thank you. And we will go back to India just as it's the largest allocation in the portfolio as well. And as you kind of alluded to in your previous answer, it has been touted as quite expensive. Do you think that it is still expensive after the sell-off and then rebounds? And if so, is there sort of much dispersion amongst the different sectors as to what's expensive and what isn't?
Yeah, I think you can't say India is not expensive. It is an expensive market. I think how you justify is the growth on offer. So, there are many well-managed companies that over the last 20 years used to be more mid caps and have become large caps and have delivered, consistent 20% earnings growth for decades. So you need to believe that that's possible to pay up for some of these names. There are pockets of the market that are more value oriented and offer a bit of a dividend yield, but they're few and far between. I think you did see some of the froth come out of small and mid caps, particularly around the Made in India story, which was a big theme. I think also one of the reasons the market came off last year and early this year was because Modi hasn't had a blank check in the last elections. He has had to govern through a coalition, so he had to change tack a bit in terms of the policy priorities. And whilst they're still investing a lot in infrastructure and capex, which is more supply side oriented policy, he's had to do a bit more fiscal handouts and support the rural economy, which is not necessarily a bad thing because he was leaving a lot of people behind, but it has, taken some froth out of some of the more industrial segments of the market. And at the end of the day, you need to see earnings delivery come through to justify these valuations. So we have been we have again a rich pipeline in India as well, but what's stopping us from adding more is the valuation. So we've been waiting for opportunities there, and yeah, and frankly, I think I feel more inclined to reduce India at the moment than increase, even though we're underweight. So still feel that it is a little bit too expensive at the moment.
Interesting. Thank you very much. And now we're going to get back to Indonesia, which has sort of come up a couple of times now. And we could try and combine these two questions together, given they're on the same country. One of them talks about your comments on the bond market and the earnings yield premium over bonds at the moment. Would you consider yourself tactically boosting exposure to the Indonesian market to take advantage of those factors? And then also, there was a question about the proposed sovereign wealth fund in the country and whether this could increase their stock market, and would that help sort of affect your allocations at all?
Yeah, I'll start with the last one because it's a pretty important question. I think one of the concerns with bond investors and the market in general is we've had a change in government last year. General Prabowo has come to power, and some of the moves he's made could be quite binary. I think they make sense if you're looking at things with a glass half full, but they could also raise risks if you're more pessimistic. And I say that because he's been centralizing power quite a lot. He's been bringing all the SOEs under one umbrella, which is this institution called Danantara. And if he manages that well, it could be, he's trying to mimic Temasek in Singapore. It could be really exciting. It will, create more centralized wealth that they can deploy capital more effectively. And they've actually tried to bring very professional people to the advisory board of that institution, including Ray Dalio, for example, who actually is not going to be formally involved, but he's going to be an advisor. So there are some very positive aspects to it, but there's also been a lot of change in the budget, change in spending, and because centralization of power is not always seen as a good thing in emerging markets. We're taking the example of Turkey, Russia, or whatnot, and Indonesia does have a history of dictatorship, and in fact, Prabowo is a son-in-law of Suharto. So I think there is also a dark side to it. So to go back to the first question, we are being a bit cautious, despite thinking that valuations are incredibly attractive. Indonesia has sadly disappointed many times in the past in terms of equity market performance, and we've been overweight. So actually, over the last 5 years, we've probably brought that overweight down. We're still overweight. We're very comfortable with our current exposure. So we're trying to manage that risk a little bit more top-down than other markets where we might be more inclined to follow the bottom-up story. We're trying to manage our risk in Indonesia a little bit. So that's a little bit of a cop-out in terms of an answer. I think the valuations are very interesting. There's some well-managed companies, but consumption's been a bit tepid. I think it'll take a little bit of time for the government to find its feet and win markets. So we're basically buying some time, doing research and finding the right groups to back and when will be the right time to buy them. But our key holding in Indonesia, AKR, is about 2% of the portfolio. We're very comfortable with that. It offers an 8% dividend yield. They have a nice large industrial estate, which they're selling land to big multinationals which play on the nearshoring theme, and then they're going to supply utilities to those businesses that buy the land in their industrial estate, which is linked to a port. So I'm going into too much detail, but it's a very nice, solid business with growth and a nice dividend yield. And I'm actually going to visit their industrial estate in November, so I'm looking forward to that. But yeah, we like Indonesia, but it's not as clear cut as we'd like.
That's interesting. Thank you very much. Right, we're going to take a step up now and do some more macro focused questions on the broader region. So we couldn't speak to an Asian manager without mentioning the dreaded tariff word. How has that affected your outlook for the region, and are smaller companies perhaps in a better place than large caps?
Yeah, look, I think the first thing to say is that no market is immune to the tariff situation. I think certainly the wrecking ball that Trump used in April did send markets into a tailspin, and actually the recovery has surprised us in terms of how strong markets have been since then. I think there is this perception that Trump will back down, and it was all just for just as a starting position. We did see yesterday announcement of a deal with Vietnam, which brought down the tariffs from their initial 46% to 20%. It's a little bit light on detail. There is a 40% tariff on transshipment, which is not very clear how that will work out. But essentially, it's not bad or good news. It's sort of neutral. I think it's better than the worst case scenario. I think it's much better than the tariffs levied against China. So that still puts Vietnam in a good position. I think at the end of the day, in my perspective, tariffs are going to bring down global growth and prove more inflationary in the US. So I think, if anything, I think it's most damaging to US consumers. I think if you're backing businesses that are hard to replace, you will see those companies pass through costs and pass the higher cost through in pricing. Where those businesses are substitutable, if that's a word, then they might have to take a bit of the pain. So it's a mixed picture. It's not great, obviously, but I don't think it changes that much over the medium to long term. I could go into more detail, but I'll just pause there in case there are more questions.
There is one that sort of spins off the back of it, and just because we are at time now, I think this will be the last question, unless there are any burning ones that come in the next couple of minutes. But one of the big consequences of all the tariff regime is the weakening of the US dollar. This is typically quite positive for emerging markets, economics 101. Is that helping the outlook for your asset class?
Again, I think it varies by business, so or by sector. So export-oriented sectors suffer a bit more. So in Taiwan, for example, you've seen a pretty strong currency, which is not good for the Taiwanese businesses because their revenues are in dollars primarily. So they suffer a bit. But for domestic companies and for the portfolio in aggregate, appreciating currencies is a good thing for returns to investors. So we just need to be very careful about how that impacts businesses individually. I think one of the key things we avoid is companies that take on foreign currency debt without foreign currency revenue. So we totally avoid companies with mismatches on their balance sheets because that's a sure way of potentially going bust. So that's the key thing. I think it is quite interesting with the US dollar weakening that you are potentially seeing, despite concerns about the global economy, people not move to the US as a risk haven asset. So that brings up much bigger questions around the sustainability or the attraction of the US as a reserve currency, which I think points to the fact that actually EM and Asia have been more orthodox in the way they manage their economies. Since COVID, you actually see EM bonds significantly outperform developed market bonds. And I'm not saying that will happen to equities, but the macro outlook in equities is in these countries actually is okay. China is a more complicated beast, but I think debt levels are fine, inflation's under control, and growth is coming through, which provides a good backdrop for the companies to grow. The currency is very difficult to predict. I would say I wouldn't expect that to be a key driver of our companies' returns. But they typically can manage that, and it should be good for the asset class if it drives flows to equities.
Brilliant. Well, that is beyond time. Any questions we didn't get to, I see one has come in, we will respond to you specifically on that one. But it just leaves me to say thank you very much, Gabriel, for your time today. Thank you to all of our listeners for tuning in. We've had really good engagement. So we will put a replay of the presentation and the slides on the website in the coming days. Whilst you're there, you can have a look at the abrdn Asia Focus page, of which a new note will be coming out shortly. And if you'd like any more information on the trust in the interim, please visit the abrdn Asia Focus website. Thank you very much, and please enjoy the rest of your day.
Thank you.